Okay, so look at the transports, and here we have the 10, the 20, and the 50-day moving average. And you can see that the 10 has crossed below the 20, and it's now curling downward. It's sloping downward, as well as the 20-day. You can see that it flattened out, and now it's beginning to curl downward. We are coming in at a rising 50-day moving average, and that is bullish, but check it out. We've dipped below the center line on the MACD. The RSI has broken below the 50 level. This is bearish, and this is showing weakness on this chart. Now, if you look closely, you can see that this was a hammer candlestick, and these are reversal type of candlesticks, but in order for this candle to have confirmation, it must close above the intraday high of the session, and in this case it was 516.35. I was looking for this and we never got that. Notice the wick here and the 10-day moving average coming in sort of in agreement with where the prices were sold at. You can see that sellers are stepping in at this same 10-day moving average on its way down. When prices were in an uptrend, you could see that prices were holding at or above the 10-day moving average, occasionally dipping below, touching the 20, but on the way down they're holding as resistance. Now this is the transports again without the moving averages, and I wanted to show you the rising wedge, and prices broke down from that rising wedge, and since then they have formed sort of a mini lower high and lower low pattern. Now with the stochastic oversold, and it does appear like it wants to be, well, it looks like it wants to curl back up. That's very possible, because remember, this is coming in at that rising 50-day moving average. Plus, over here we have two previous resistance points, and now should act as support. So when you combine the three, you have sort of a confluence of support, and that may hold as true, but it's something that I'll be watching. Now take a look at the Russell. The Russell has not quite done what the transports have, but it does appear that it is either consolidating or it's in a distribution phase. I'd like to see a break below the lower trend line to validate the distribution phase, where prices would break below. That would also come in with breaking below the 20-day moving average. The MACD could then push lower, get further away from its signal line, and prices could begin their downtrend. Now you could even say that the RSI is diverging if you account for this being a double topping pattern, but as of right now it's basically a 50-50 chance. If there is a break to the upside, that would better define the divergence for the MACD, and it would look something like that, as well as the RSI. So again, we'll have to wait and see. But given the fact that on the daily time frame, again, we have just the major divergence in play, your odds are to the downside, but we'll wait and see. We'll see exactly what happens. Just to give you a better idea, this is the Russell in the hourly time frame, and with this previous peak, you can see the stochastic is rolling over, coming off of overbought levels. We have not yet pushed into negative territory on the histogram bars, but so far it looks to be setting up a lower high in play. Now it's possible that we could also diverge. We could set up a smaller divergence where prices get back above, making higher highs, breaking above this trend line, and like I said, it would better define the divergence on the daily time frame before we ultimately give back. But nevertheless, it'll be kind of a wait and see game where prices are narrowing in. Whether they break to the upside, that's okay. If they break to the downside, either way, this is all long overdue. This is the New York Composite Index. Again, we have the stochastic showing divergence. We have the larger divergence shown by the MACD. I thought it was interesting that with this head and shoulders topping pattern, it seems like this one is the only index that is following what it should and that is coming back to the neckline of the pattern. And this is a rough drawing of where the trend line should be, but it's closer than any of the other indexes, and I thought that was interesting. So could be that the composite index is telling us, the tell-all. It's telling us that maybe after prices can get to this neckline of the pattern, then it's at that point that prices will then roll over. And it kind of makes sense, because at this point I'd say the market is extremely toppy, and a reversal is due at any point. So the market is toppy, and I have here below, this is the McCullough oscillator, and this is also diverging from what prices are doing. Prices are making higher highs, and you're not seeing that from the McCullough oscillator. It's very similar to the MACD that I was showing you in yesterday's video. It's a fairly good tool in calling for tops and bottoms. It gives its best signals when you see the divergence that play out. In this case, again, you had a divergence with the August and October lows. Very similar pattern taking place with the run up to the May highs. You often see this. It's very good. So you use this when in agreement with many other of your indicators, and it kind of helps bring together the full analysis of the market. One last thing with this oscillator, you can see that it is below the 0 point, and yet prices have rallied higher. So it's kind of telling you to not believe this rally. It's telling you that it's not a legitimate rally. Still looking like it wants to go lower. We did break this previous low, so it's likely that prices are probably going to come to this trend line. That would allow for the MACD to set up a divergence. I think the same thing's taking place with the stochastic. We're not quite oversold, but it looks like, given the length of this move down, it's possible that we may hold up a little higher in terms of how oversold compared to this previous point. And I showed you the weekly chart, and I think that would also correlate with further weakness. So we'll have to see, and that hopefully will play out that way. Take a look at the weekly time frame. I'm using the 10, the 20, and this is the 40-week moving average, which almost correlates to the 200-day in the daily time frame. So that could allow for prices to get down to this level. If you use that in agreement with the daily time frame, this says about 77 and 5 cents when you draw it. It's possible. Yeah, so it's a rough estimate, but that would almost be a good area at which the dollar could then find support at. One last thing with the dollar, this is the daily time frame. I wanted to show you here the Fibonacci retracements. It does look like we're coming in at the 50. It's possible that the next move lower could bring us to the 61.8. You throw that in with a trend line, and depending on how you draw it, it could be including that wick or not. But sometimes prices will overshoot those trend lines, as well as get down to the 61.8 before they resume the uptrend. So it'll be this area that I'll be following closely, So here we have gold to the left, apples to the right. I just want to show you how similar the pattern is. You can see as the run up all the way from July to the September highs, there is sort of a mini parabolic move that's taken place, and most parabolic moves last about 3 to 4 months. Notice how the first run up exceeded these previous peaks, and we gapped up even further. There was a small pullback, and then it rallied back up to the highs. Well, not exactly, but it formed a double topping pattern. Now if you look over here, we're doing the same thing. We exceeded these peaks, we gapped up, there was a small pullback, rallied to the highs, we sold off. Now we're forming a double top pattern again. So just keep in mind how similar these patterns are, and the fact that we're pretty overbought in the market and getting to a tipping point that would correlate with this move to be almost complete, and once it does begin to sell off, that would bring the Nasdaq
And lastly, I
down
want
as
to show
well.
you the relationship between the S&P and copper. I'm using JJC, which is it's a close pick to the metal, but you can see that when the two are diverging from one another, oftentimes it calls turns for the market. If you look, copper was, well, the S&P was making higher highs where copper was not. It was making lower highs. Again, you can see that it was building a base. It was climbing sideways to a little higher, whereas the S&P was not. It was moving lower. You can see that at that point that they were in agreement together, and this rally was a legitimate rally. Now we're coming in at a similar point where prices are making higher highs, but copper is not. It's making lower highs. So when you use this metal along with your other indicators, it gives you a pretty good signal for turns in the market. Okay, thanks a lot, and hope you enjoy the video.